As you are someone who's enjoyed success in political commentary, I'm wondering how one is able to break into the field. I've been actively promoting my political principles through a blog, but would like to transition to something full-time that can reach a much greater audience. Are there any suggestions you can offer?
So I didn't succeed. I have a radio show right now, but I don't make any money on the radio show, so I don't know that I'm the right person to ask. My career is in finance. I have a brokerage firm, a precious metals company. I have a brokerage firm in Canada. I have a bank in the Caribbean. So my income comes mainly from running those businesses. Now, I did write some books, and I was able to sell some books, but they more have to do with the economy than necessarily politics, although the last one, The Real Crash, had a lot more politics in it than my prior books. But for me, the idea about politics is something I've done, in addition to and to help promote my other businesses. And I do think it's important that I get the word out there. That's why I am spending time on the Peter Schiff radio show. I'm trying to get more people to understand the grave dangers we face here in America and why we face them, to get people to understand that the government is the source of, not the solution to, our problems, and that they're not getting the truth from the mainstream media. But I haven't really figured out how to, do it, in a way that's going to support you. We have a YouTube channel. I do think that, I think it maybe throws off some revenue because now we have some ads on the YouTube channel, and I think to the extent that if you have a YouTube channel and you can get people to watch your videos, you can make a little bit of money if enough people watch them. And whether or not you can turn it into a career, you're really going to have to put out a lot of content, and people are going to have to watch it because you don't make a lot of money from each individual view. There are people out there that make a living, right? There are people that actually get paid decent money to be political commentators, but there's not that many of them. I mean, you might have a better chance at playing in a professional sports team than making a decent living being a political commentator. But I don't know. But good luck to you.
Jacques from Braga, Portugal asks, "It seems the euro is becoming a stable currency. Should Europeans buy gold or stay in the euro?"
Well, I think that over time, the euro is going to lose value against gold. There's no question in my mind that it will. So I don't think that the Europeans are out of the woods and that the Europeans should just be complacent and think that the euro is going to be a store of value long term. It won't be. But I think in the short run, and even probably over a longer time period, it will be a better store of value than the U.S. dollar. I've been saying that for the last several years as people were selling the euro and buying dollars, that they were jumping out of the frying pan into the fire. So for now, I think you're getting a relief rally in the euro, and the euro price of gold is going down. If I were a European, I would take advantage of the pullback in gold in euro terms, and I would buy more gold. I would not, on the other hand, buy dollars. And of course, I think there are other currencies that Europeans could own that will also do better than the euro over the long run, even though the euro is probably the strongest currency on the planet right now. I don't think it's going to stay the strongest over the next several years.
Jacques from Bucharest, Romania asks, "Do you think Bernanke is losing it or has lost it mentally? I can't help but think of 1920s Germany. In Lords of Finance, they mention how the finance ministers in Germany suffered mentally from all the inflation. Because the numbers got so out of control, the actual magnitude of the economic events were mind-numbing and ultimately mentally debilitating for policymakers to perform their duties in a practical manner. I wonder if Bernanke is suffering similarly." Well,
first of all, your presumption there is Bernanke ever had it in the first place, because you can't lose something that you don't have. So I don't know, what Bernanke knows or doesn't know, whether he's just ignorant or whether he's lying. You don't know. I mean, obviously he has an agenda. There may be a method to his madness. It's clearly madness, but maybe he actually believes that he needs to do whatever he can to postpone the inevitable because it's going to be so painful, and maybe he's hoping for some kind of a miracle. Maybe he appreciates how bad the situation is, but just hoping that there's some miraculous way that we can get out. just like Bernie Madoff. I mean, Bernie Madoff told interviewers, yes, he knew what he was doing was wrong, but he had hoped for a miracle. He hoped that something would happen and everything would be okay. Maybe Ben Bernanke thinks if he can just print enough money and delay the collapse, that something will happen so that the collapse is no longer necessary. But I think that's a foolish way to run a country. It was certainly foolish for Bernie Madoff to run his small Ponzi scheme that way. I don't think we should run the entire country with Bernie Madoff as a model.
George from Mount Prospect, Illinois asks, over the past few years, instead of overpaying my mortgage, I have been buying physical silver. I have just refinanced to a 30 fixed mortgage at 3.5%. I need to pay this mortgage off in 15 years. Should I continue to play the silver game or just overpay the mortgage?
Well, I mean, personally, I got a 30-year fixed rate mortgage and I'm making the minimum payments that I can. So I think that you're better off doing other things, whether you should only buy silver or look to diversify. That's the question you might want to ask yourself. I mean, if you're collecting you're paying rather a 3.5% mortgage, silver throws off no current income. So, you're out that income. You have that opportunity cost. But what you can also do is look at foreign stocks that also get you out of the dollar, but where the yields might be 7%, 8%, 9%. And so then you're actually getting additional income, cash flow, that exceeds the amount of interest you're paying on your mortgage. So you kind of create your own carry trade where you have positive cash flow and the income, the dividends that you receive on your stocks pay for the interest on your mortgage. So I think that's what you should be looking at, diversifying your portfolio so that it's not just silver, so that you own other assets, other income producing assets that might appreciate in an environment where maybe silver pulls back. It's always good to have some diversification, not to put all of your eggs in the same basket. Even if I personally think that's a good basket, you never know. And so I think it pays to diversify into other asset classes. I can't really get into that now, but what you should do is contact one of the brokers at Euro Pacific Capital and find out which of these stocks may be suitable for your particular circumstances.
Patrick from Pasadena, California asks, for those of us who have student loan debt but are able to make the monthly payments and have some savings, should we try to pay more to the loans to get out of debt, or should we pay the minimum and use the savings to purchase silver?
Yeah, again, I don't have any student loans personally, but if I did, I would not be in a hurry to pay them off. I mean, I would try to lock in the low interest rates. I would try to consolidate the loan. But the reason that I would not want to struggle to pay the loan, I think there's two reasons. One is inflation. I do believe that there will be a lot of inflation, and so that much of your debt will be eradicated simply because it will be inflated away. When the government inflates away its own debts, it's also inflating away everybody else's debts to the extent that they're in dollars. So I would rather pay the debt off in the future when the dollars have less value than pay it off right now. In the meantime, I would try to prudently invest those dollars in foreign stocks, precious metals, commodities, things like that. And again, talk to my brokerage firm, Euro Pacific Capital, to try to get a strategy on how to do that. The other reason is because I do believe that there might be outright forgiveness of student debt. The government, in order to get the votes of students, and students, of course, have very poor employment prospects and lots of debt, they're going to be a real special interest group. And their numbers are growing every day. And I think politicians are not going to be oblivious to this voting bloc. And one way to buy them off is to promise them some relief from their student loans through, debt forgiveness. And so, why pay your debt when a portion of that debt or all of that debt may one day be forgiven, by a congressional act? Now, I realize this is a moral hazard. This is the problem with government bailouts. It influences behavior. And there's a pretty good probability that students are going to get a bailout. So if you're responsible and pay off your loan, you lose in that deal because you miss out on the bailout. The people that don't pay, they end up getting this big benefit, and the people who thought they were being responsible end up screwing themselves out of a deal. So I would hold off on repaying as long as possible, make the minimum payments, and let inflation and a potential bailout do most of the work for you.
Suhas from Pune, India asks, you keep saying when the interests go up, What event will trigger the rise? Who controls the interest rates? If it's the Fed, then why couldn't they keep it low forever?
The reason that the Fed can't keep interest rates low forever is because the more money they print to keep interest rates low, the less the dollar is worth and the faster prices will rise. And ultimately, it's not going to do the government any good if it can borrow money cheaply if that money doesn't give any value, any purchasing power to the people they give it to. So that ultimately is going to stop the Fed from artificially suppressing interest rates, is going to be the bottom dropping out of the dollar. Because the way the Fed keeps interest rates from going up is by buying bonds at inflated prices. The Fed overpays for bonds so that the yield on those bonds is lower than it otherwise would be. But in order to do that, the Fed has to create money out of thin air. So now the money supply goes up, and now money has less value. And of course, the more money the Fed prints to buy bonds to keep interest rates down, the less attractive the dollar is, the less attractive those bonds are to any private holders. So now there's even more pressure to sell them. There's even more upward pressure on interest rates, which means the Fed has to print even more money to keep them artificially low. And eventually, it can't do it anymore. Either it has to let interest rates skyrocket and prevent the dollar from collapsing completely, or it continues to print to keep interest rates low as long as possible, and in the process completely destroys the dollar, and you have hyperinflation. And it's that threat of hyperinflation that ultimately will force the Fed's hand, and it will result in a big increase in rates.
Tim from Tampa, Florida asks, I've been reading The Real Crash, and I agree with the likelihood of tough economic times ahead in the United States. Do you think there are companies, such as life insurance companies, that might actually benefit from an economic crash?
You know, life insurance companies, depending on how their portfolios are constructed, if it's a collapse in the value of the dollar, which is what I am envisioning, then life insurance companies benefit in that when people die and they have to pay off the policies, they're paying them off with inflated dollars. Now, that assumes that they've invested that money in the stock market or in precious metals. If they've invested their money in government bonds, then it's 6 of one, half dozen of the other. Now, if you have big increases in interest rates, that could adversely affect a lot of insurance companies. If they own a lot of long-term, low-yielding bonds, they could take huge hits. So a lot of it depends on how it plays out, how long the government waits to raise rates, how much inflation there is between now and then, how the insurance companies have chosen to invest the premiums that they've collected. So there are all sorts of factors that are going to impact how various companies will survive or thrive in the environment that I foresee.
Brian from San Diego, California asks, besides gold, would you recommend owning any other commodities such as corn, gasoline, natural gas, etc.?
I mean, absolutely. I mean, it's hard to own those commodities in a physical form, like you can buy gold coins and store them in your basement. But you want to have exposure to agricultural commodities or industrial metals through your investments, through your stock investments or through funds that hold these types of commodities. So again, for information on how to do that and how to get exposure to those kinds of commodities, talk to one of the brokers at Euro Pacific Capital.
Eric from Hoboken, New Jersey asks, why can't we get some type of move in miners? Even on some days when gold advances, miners are still under pressure.
Yeah, gold mining stocks are making new 52-week lows as I'm recording this video. I mean, even though the price of gold has barely dropped maybe 1 or 2% in the last few weeks, gold stocks are down as a group, I think 11 or 12%. So I think Wall Street is throwing these stocks out the window. Not only are some stocks at 52-week lows, they are at multi-year lows. Some of them are trading close to where they were at the depths of the 2008-09 financial crisis. It makes no sense. I think, in fact, the index, the gold index, the HUI, is trading at book value. I think it's trading at a historic low valuation. So Wall Street assumes that the gold price is going to collapse. I think that's because they don't understand the gold market, they don't understand the economy, they don't understand what's happening with the U.S., with the Federal Reserve. I think you have a giant mispricing. I think Wall Street doesn't appreciate the potential that these stocks have for the future. Now, part of the problem, though, for the gold stocks is that rather than benefiting from inflation, like they should, they're actually suffering. They're a victim of inflation. Inflation is driving up the cost of mining dramatically. But because everybody believes there's no inflation, because the government says there's no inflation, nobody is buying gold as a hedge against inflation. At least not enough people are buying. And so inflation is making it very expensive to mine gold, but the price of gold for many companies is actually going up more slowly than the cost of getting it out of the ground. And of course, so it's not a very good business to be in right now. And so the stock prices reflect that poor environment. But what I'm looking at as an investor, I'm trying to see beyond the horizon to the future, where it's a very different environment, where we've had a huge increase in the price of gold, which I am expecting to happen, which will make gold mining much more lucrative than it is today. And I think gold stocks will be valued much higher at that point. And then eventually, the psychology will turn. The people who don't understand why they should own gold will start buying it. And they'll start anticipating higher gold prices rather than lower gold prices. And when higher gold prices are factored in, discounted into the stock of a gold mining company, that means you're going to have the multiples rising. Right now, you have a lot of gold stocks that are trading at 9, 10 times earnings. I think in the future, not only will these gold stocks have much higher earnings than they do now, due to gold prices rising much faster than the cost of mining, but I think you might see these stocks trading at 20 times earnings or 25 times earnings, and therefore you're going to have more earnings and higher multiples, and I think you'll have much, much higher gold prices. In the meantime, I don't know where the bottom is, but I think that we're a lot closer to the bottom than the top for sure, and so I think you want to buy. I can't promise you when it's going to turn around, but I'm very confident that if you're patient, I think you'll make a lot of money. But again, you got to understand the risks, and also it's possible that I'm wrong, right? And maybe if you're patient, you'll just lose even more money. You've got to decide for yourself the way to go. And again, there are gold stocks that I prefer. I have my favorites. Talk to a broker at Euro Pacific Capital, find out what those stocks are, and find out if they're suitable for you.
Doug from Winter Springs, Florida asks, in a recent Shift Report video blog, Debt Ceiling and the Fiscal Cliff, you said, get out of any debt denominated in dollars. I intended on letting inflation ease my low-interest debt while making better investment choices with the money I have. However, your comment in the video makes me think I am misunderstanding something.
Yeah, you are misunderstanding me. I'm not talking about getting out of the debt that you owe. I'm talking about getting out of the debt that is owed to you. So when I talk about getting out of dollar-denominated debt, that means if you own a bond, or you own the mortgage, you're the bank, or you've loaned somebody money to buy a house, you don't want to own that asset. You don't want to own that mortgage. You don't want to own that bond, because inflation is going to destroy the value. On the opposite side, that's where you are. You have borrowed money in dollars, so you don't own the loan. You're the one that's obligated to make the payments. You're in the catbird seat as far as I'm concerned when it comes to inflation. So you don't have to get out of debt. I mean, you want to take on dollar-denominated debt. You just don't want to own it. You want to be the borrower. You don't want to be the lender, because the borrower gets to repay the lender in money that has less value than the money that he borrowed. The only thing that I caution people about is make sure to get a fixed rate, because it is possible that the Fed could really do the right thing. I don't know how to put a probability on it, and really jack up interest rates dramatically. And people that have debt where they don't have the low rate locked in, they could be in for a world of hurt if you get a big spike up in interest rates and they can't afford to make the payments. They might have to sell some of the assets that they bought with the borrowed money, and of course if other people are having to make the same trade, those asset prices will be collapsing. So I think the most prudent way to bet on inflation as a debtor is to do it by locking in these artificially low interest rates. So at least if you do have a spike in interest rates, that won't affect your cost of financing your debt, because you've locked it in.